Good morning, everybody, and many thanks to the conference organizers for inviting me to discuss this paper here. So I think this is a very interesting potential contribution to this very important intermediary asset pricing literature. It has lots of analytical results and asset pricing implications. So I'd like to first interpret the contracting setting here a little bit, and then raise some concerns about the asset pricing modeling and results, the modeling of the economy, and then maybe do a little bit more to emphasize the broader relevance of the paper, which I think is significant. So the way I think of it, there's a, if you will, a global market portfolio, which is also the index here, and this is, farms and farms of all the Lucas trees that are there. And then there's a set of these buy and hold, mechanical buy and hold investors, and you could more broadly just think of these guys as constrained people for whatever reason. So they're holding eta minus theta, so they're missing something. And you might think of them as investors in developed economies that are underinvesting, for example, in the emerging markets. Or in a more local one, maybe eta is all the principal and interest coming out of all the home loans, and the eta minus theta, these are the 2A7 funds who can only hold the short-term CMOs. And so there may be some active investors out there who are willing to hold emerging markets, or they're willing to hold long-term CMO tranches, but it's hard, maybe it's costly, you can't repo that stuff or whatever. So they need a manager to get QFII licenses or figure it out. And so independently, the investors can only hold the pass-throughs or the global market index, and the managers are giving them access to the other portfolios. And Equillibrium prices are going to make holding theta optimal, because these are the optimizing investors. And so that means relative to the eta portfolio, theta is going to have alpha with respect to the eta portfolio, because we know that essentially alpha is how much you would need to reduce downward the mean return on theta in order to make you happy to hold eta, or in other words, it's the shadow price of the constraint of holding eta, as for example, in Quoco and so on. So this means there's scope for the managers to add alpha and collect fees. And I think this is actually a very reasonable baseline description of the whole asset management industry, which is there's people who are constrained, which means there's alpha out there if you can find it, and the role of asset managers is to relax those constraints. I realize there's lots of other things they do, and there's other dynamics going on that are no doubt important. For example, there could be incentives from fund flows and tournament behavior that will change things here, but I think this is a good baseline workhorse. So here's how Phil Dybvig and Heber Farnsworth taught me to think about this problem. So the manager can exert costly effort to increase the quality of the signal about the long-term CMOs or the emerging markets securities. In the first best, both the effort and the signal are observable. So the investor can just tell the manager how hard to work and tell the manager what portfolio to hold, what trades to do, and maybe the manager just goes out and gets the QFII license or whatever to go ahead and do that. And then in the first best, they both just hold their optimal portfolios as according to their bargaining power. In the second best, the effort is unobservable. So that's where the agency problem is, but the signal is still observable. So once the manager goes out and generates the information, there are reports that are available, and then the investor can still tell the manager what portfolio to hold. But in order to induce the effort to generate a good signal, the optimal fee now has to overexpose him to the managed portfolio, which is essentially the flavor of what we see in this paper. And so, but because the manager can underreport the signal, he's going to try to offset those effort incentives by essentially closet indexing, which is also the problem that you get here. And then in the third best, this is the problem where the manager can hide the signal, then the solution is to have a third best contract, which is not a pure benchmark, but which adds additional incentives to get the guy not to closet index, which is not the solution here. The paper solution to the problem of the second best problem in the third best world is different. So the way I see it here, right, the investor can only get access to alpha through the manager, and somehow the signal about where that theta portfolio is non-contractable, though presumably he knows where it is because that seems to be in his optimization problem, but it's non-contractable. And the manager has incentive to shirk or cannibalize the fund return through some kind of tunneling or inefficient investment. And here the investor restricts to contracts which are a share of the managed portfolio minus a share of this benchmark ADA portfolio. Now you might say, well, but he doesn't have to use those contracts. There are better ones out there, and there are. I actually don't have a problem with this. This is what a lot of contracts that we see in the asset management world look like, and so there's probably good reasons for that. Simple rules of thumb, simple performance measures, bounded rationality. I'm fine with that. But so what you get are that in the privately optimal equilibrium, you've basically got the second best contract in a third best world. You get closet indexing and inefficient allocations. In the socially optimal equilibrium that they look at, now the social planner internalizes the equilibrium impact of the way these contracts are used on the asset prices, and so then there's even more alpha to be had, and so then the manager has less incentive to closet index. So I think of it as the inefficiency is partly addressed by moving us to closer to a second best contract in a second best world. So there's missing fund flow incentives. You might think that those would create tournament-type behavior of managers competing with each other, and that might also make for more aggressive trading and less closet indexing. I have some concerns about the way the economy is modeled, and I think that those might be driving some of the anomalous risk-return relationships and the volatility anomaly here. So the paper's using what seems like a non-standard dividend process. It's a stationary square root process. It's mean reverting. And so you get prices that are stationary, and basically there's no long-run growth here. So I'm a little bit concerned because most of the empirical regularities that the paper is referring to are taking place in an economy with growth, and I think that is going to be affecting the return dynamics. The other thing is I find it a little bit difficult to interpret the return moments that the paper's using. There's a notion of return per share, and then there's also return per dollar, but it's a little bit simplified. And it strikes me that the way that you'd want to look at this, since you're in the continuous time framework and you have that machinery there for you, would be to look directly. I wonder if is this a pointer here? Look directly at the security price evolution equations and the instantaneous appreciation rate and volatility processes. And it seems to me that, for example, okay, so I took a little shot at it with a case with just the idiosyncratic component of the dividend in there, and calculate stochastic time-varying appreciation rate and volatility process. And it seems to me that in any case, that the continuous time counterpart to, let's say, the coefficient on IVOL in Fama-Macbeth cross-sectional regression would be, you would get from looking at the cross-sectional relationship between mu I minus r and sigma I, for example, here. And more generally, you could do that if you had many factors up in here. And then, so that would that would essentially give you that instance Fama-Macbeth cross-sectional regression coefficient, and then you could look at time series average or unconditional mean of that if you wanted to try to talk about the connection between the model and the empirical irregularities we see. But I think, so I get this sort of hump-shaped volatility function because the volatility dies away as prices get away from their long-term mean. And I think that that's driving the anomalous volatility results here. And then it makes it hard to interpret then. This is just in the model without frictions. So then if you go to the model with frictions, well, then you've got to disentangle what are the frictions causing over and above what this is causing. And it seems like it's hard to interpret there. And you'd want to look at this in a setting with in an economy with growth and with a more traditional kind of dividend process. But, and the other thing is the supply effects here are framed in terms of the relative values of the thetas in the cross section. And I think to address more directly the macro frictions that are causing the role for delegated monitoring in the first place, what you want to look at are effects related to essentially the excess supply, not just the supply. But I don't want to be too discouraging. I actually think that the paper is addressing a really important problem. And so this whole intermediary asset pricing literature, I think, is very important, and we're learning that since the crisis for sure. But what this paper is really emphasizing is that these buy-side frictions could be very important. And I think that actually is a place where we should be looking. And also, if you think about distortions to asset prices that are happening because of things going on the right-hand side of the financial system balance sheet, those are also then bleeding into the cost of capital distortions on the left-hand side of the financial system balance sheet, where all the Lucas trees are being planted and maybe distorting that. So to kind of bring that, make that salient, I've kind of mapped out, let's look at the financial systems in the world's two largest economies. So the US, which is the one that the paper's sort of talking about, but you could think about other ones, and also China's. So by some measures, these economies and financial systems are basically the same size. And so here's the financial system in the middle, and I'm thinking here's the balance sheet. So here's the assets of the financial system, and here are the liabilities of the financial system. And capital's going this way, but securities are going this way. And since we're finance people, I'm focusing on the flows of securities. And so both the US and China are outliers in terms of their financial systems. The US is a very heavily securities market-based system, and that while conversely, China's is a massive bank-based system. And those structures are completely rooted in the culture and the political economy of these two places. So this markets-based system is supported by this massive buy side, right? Individual households mostly hold funds. They don't directly hold this. They don't directly hold long-term CMOs. Since the crisis, there's been a lot of focus on these frictions that happened here with the GSEs. But what the paper's going after is what I think has got to be at least as important, is what happens when you have agency frictions here that then affect this cost of capital. I mean, we know that the whole process of the idea of creating mortgage-backed securities is to essentially lower borrowing costs for people over here. So we know that this intermediation has an effect on cost of capital and an effect on the macro real economy. But there may be other things, closet indexing, for example, that are other problems. China's system is completely dominated by its banks. That is the instrument of centrally planned investment. And most of the investment here, how do the Lucas trees get planted? The banks lend to these SOEs. There are increasingly these SMEs. These guys seem to be planting much better Lucas trees. It's really important, actually. China's the world's largest investor and the greatest contributor to global growth by wide margins over the US, and will remain so for many years, right? These are the people planting the world's Lucas trees. Whether or not they get it right will be of global importance for everybody. And that's all right on the head of a pin right now. It's all balancing on the reform of this sector. There are some markets, and they are developing, and my research with Robert Whitelaw suggests that they're actually functioning very well, but they play an important counterpart. They add transparency to this very opaque system, which is very relationship driven. There is a buy side, but the bit of it that's external to the banking system is very small, only 5%. Most of it is internal to this banking system. So these trusts, these shadow banks and banks are also shadow mutual funds. It strikes me that issues of closet indexing and so on would be even more pronounced in China, where there's political and cultural reasons not to break out. And that the growth of this is going to be important for fueling growth. At the moment, households just go to ICBC. It'll be interesting to see how it improves the efficiency of what's going on when households can start to consume digestible portfolios of securities as well. So in summary, I think that the paper is tackling a really important and ambitious problem and a hard problem. And I think the contracting framework is reasonable, and it's a reasonable workhorse for a starting point for thinking about the buy-side's role and how it fits in and where those contracting problems lie and what frictions they can create. I do have some concern about the way that the economy is modeled, and I think that you'd want to have growth in there. But I think these results are broadly relevant, and the paper could do even more to emphasize their broad relevance. Thanks.
Thank you, Jennifer. Do we have any questions?